My name is Mike Clare, Senior Portfolio Manager at Brompton Funds, and today we wanted to provide our investors with a brief update on oil markets and talk a little bit about why we remain bullish on oil here, and then talk a little bit about how investors can get exposure to oil and energy themes. So in a nutshell, the oil market is pretty tight. Here's our summary of why we remain bullish on oil. First, global oil consumption has now surged back to pre-pandemic levels, but it is also likely to rise further, particularly with China reopening here in 2023. At the same time, supply is not keeping pace with demand. So global energy capex is really down quite substantially and well below the peak we saw in the last cycle. And this is because producers are reluctant to increase spending, even in the higher oil price environment we've seen over the past couple of years, partly due to a challenging political environment for oil and energy, but also because of investor pressure to prioritize capital returns over in investing in new growth. As a short-term solution to tight oil markets, the U.S., of course, has flooded the market with a large release of barrels from its strategic petroleum reserve in 2022, and that should translate into potential future demand for oil, which would help support the oil price. The result of all this is that forward oil prices likely need to continue moving higher to incentivize new production from producers, and at the same time, North American oil producers, we think, remain attractively valued here. So let's dive into some of the details on each of these points here. So first, oil today is a story of supply and demand. So first on the demand side, you can see on the chart here, global oil consumption is now back above 100 million barrels per day. So back to pre-pandemic levels. But if you look at that pre-pandemic trend line, it goes all the way back, we're showing back to the late 90s, but this trend line goes back to the mid 80s. You can see that pre-pandemic trend, if we had followed that, oil demand would be roughly 4 or 5 million barrels per day higher than where it actually is. So there is room for further demand growth. The sources of that, where we think that could come from, first of all, China reopening their economy. We could see roughly 1 to 2 million barrels per day of additional demand just from China, as they're currently consuming around 8 million barrels per day versus 9 pre-pandemic, or 10 if they followed their pre-pandemic trend line. At the same time, global jet fuel demand is potentially going to rise another 1 million barrels per day, just implied by the current flight schedule that we see. And then you've got, as I mentioned, the potential refilling of the Strategic Petroleum Reserve in the U.S. As the U.S. Administration would look to add barrels, particularly if oil prices do correct. And then lastly, global growth remains strong, particularly as we've seen and to start 2023 with what we think is an increasing probability of a soft landing, which should support oil consumption growth over the coming quarters here. So now let's look at the supply side. Here we're looking at energy capex. So capital expenditures are down quite substantially from the peak we saw in 2015, as producers just aren't responding to higher oil prices. Now, we think there are 3 main reasons for this. First, as I mentioned, on the political side, so things like net zero emissions targets and ESG really are not supportive of long-term investment decisions that a lot of these oil companies need to make to bring new supply to market. Number 2 is psychology. So I think a lot of these oil companies still have fresh memories of the poor returns they generated on capital expenditures in the last cycle, from 2010 to 2014, where a number of producers overspent and then really didn't generate the required return they needed to see on those projects. And then the third reason would be investor pressure. So there's been investor pressure on companies to not overspend. Investors lately have been rewarding capital returns like share buybacks and dividend growth over production growth. And you're seeing the oil sector respond to that. So what's the impact of all this? Well, you can see on the chart here we're showing energy capex for the S&P 500 energy index, relative to that 2015 peak. So the 2015 peak is 100 on the chart. You can see it's down quite substantially. But if we also look at things like global spending, global energy spending is down roughly 45% from the 2012 to 2014 average at the peak of the last cycle. And then if you look at things like final investment decisions on large projects, so you go back 10 to 15 years ago, on an annual basis, we were sort of the sector was making final investment decision on roughly 100 plus billion barrels of oil equivalent of resource per year. And now since 2015, that's declined to about 30 to 40 billion barrels of oil equivalent of resource per year. So we're just not seeing the approval of these big mega projects like we had in the past. So what does all that mean in terms of inventories? Well, I mentioned the the market has been tight. You can see here the impact of the drawdown that we saw in the Strategic Petroleum Reserve from the US. So that SPR declined by 221 million barrels in 2022 and is currently 284 million barrels below its 2020 peak. And then if you look at total inventories, what we're looking at the chart here, total US inventories, including the SPR, it's back to levels we saw just below what we saw in early 2001 and really back to levels we saw in the mid 1980s. So this drawdown in inventory levels, does create a future buyer for oil in order to restock that SPR. And we think that really helps put a floor on oil prices, particularly in, a downside scenario for the economy. And I think that certainty will help the producers or the E&P sector from suffering the drawdowns we've seen in past downturns. So, let's talk a little bit about forward oil prices. So what we're looking at here on the chart, the solid blue line shows spot oil prices going back to the end of 2018. And then the dotted lines show the forward futures market price, a futures curve as of the end of each year from the end of 2018 through the end of 2022. You can see in the last cycle, we had some volatility in spot market oil, but the futures price typically landed around the $50 per barrel level. And really since oil prices started moving higher after the pandemic, we've seen an upward shift in that, forward curve for the first time in a decade. And really here, the key message we want to get across is not to focus too much on spot market oil where we see a lot of volatility, but really focus on that forward curve. And we think that these forward prices really need to continue moving higher to support the new supply that we need to bring on to match the demand growth. Particularly prices need to move higher because the political environment with things like net zero targets is going to make it so that these big oil companies want to have a quicker payback period on their investment to make sure that they earn a return. And so that's going to see the need for an ever increasing futures curve here going forward in our view, at least for the near future. Next, let's just look at big macro trends. So we think big macro market trends tend to last for at least a decade. And so here we're looking at simply the S&P 500 energy sector versus the S&P 500 technology sector. You can see that obviously technology did very well relative to energy in the 1990s, and then that trend reversed. In the 2000s, energy had a big move, particularly relative to technology, even though tech did, off the bottom in the early 2000s, even though tech did well over that time frame. And then that reversed again in the 2010s, where you saw big outperformance from technology, even in the early 2010s when energy peaked in the last cycle. And essentially, we think this sets up a potential, outperformance of energy through the 2020s. And that sort of lines up with this underinvestment that we've seen over the past decade, lack of CapEx in the space. That has potential to drive this outperformance for years to come. At the same time, the North American oil producers continue to trade at what we view to be attractive valuations, particularly when you look at things like free cash flow yield, in the 10 to 15% range, still looks, even with the run we've had over the past couple of years, still looks very attractive relative to other sectors. So let's just look at our Brompton Oil Split Corp, which is our split share fund focused on the North American oil sector. Gives investors two ways to play oil, two share classes. First, we have OSP, which is our Class A share and offers investors enhanced exposure to the portfolio returns. And then we have our preferred share, OSP.PR.A, which we recently announced we were extending for a new one-year term starting on March 31st, which will have an 8% coupon. And this translates into a yield to maturity of 8.7%, which is also 10.5% on a pre-tax interest equivalent basis. And that would be for Ontario holders that are in the top marginal tax bracket. So it does look pretty attractive relative to, even the higher rates we see out there amongst the fixed income markets. Lastly, I'll just touch on, some of the portfolio holdings here. So it is what we think is a pretty high quality portfolio of oil-focused producers, as well as some of the super majors and integrated oil companies. The sector really is producing a lot of free cash flow these days and returning that to investors. You can see that lately with announcements from companies like Chevron, where they announced a $75 billion share buyback. So, we think it's a good quality portfolio and a good way for investors to get exposure to the sector. And just lastly, before I wrap up here, I would point you to the disclaimer and just note that comments today do contain forward-looking statements, and the date of this recording for reference is February 3rd, 2023.